Good morning and welcome to NISA's Summer Economic Forum. My name is Adrian Pabst. I'm the Deputy Director of NISA for Public Policy. And it's my great pleasure to welcome you this morning. We have a very exciting program where we're going to present our latest global economic and UK economic outlook for the summer 2021. And we're also covering some other very closely connected questions on UK foreign aid and on the regional outlook. I'm delighted to be joined by my colleagues, Barry Naisbitt, Dawn Holland, Cyril Lenoel, and Anna Bhattacharjee. We will introduce them as they deliver their presentations. Before they do so, let me just make some preliminary remarks, if I may, to set the scene. Clearly, this is a difficult moment for both the United Kingdom and the world as we emerge from the cloud of the shadow of COVID-19, I should say, with enormous pressures on policymakers because the judgments going forward are under ever greater scrutiny. What to do about fiscal policy, what to do about monetary policy, and indeed other instruments such as industrial policy. Our outlook for the global and for the UK economy suggests that the recovery is gathering pace and indeed is strengthening pretty much around the world. However, it also suggests that monetary and fiscal policy have to be deployed differently than they have been in the last decade or so since the global financial crisis. There are some very fundamental questions of coordination, of dominance, which policy has to guide and lead this recovery. What are we aiming for? What are the targets? And what are all the instruments that we can use? Because both the uncertainty of this coronavirus crisis, the radical uncertainty, we could say, as well as the risks of either not doing enough or doing too much is now very clear for us to see. Not doing enough could be not enough fiscal policy support, in order to stop the recession from getting worse. And not doing enough might be not to act early enough on possibly inflationary pressures. We've done some work in the spring, which we published as an occasional paper on new fiscal frameworks, where we suggested that the fiscal rules that have been in place in the United Kingdom and elsewhere have been arbitrary and have really served practically no purpose, not even the purpose of controlling deficit and debt levels. And therefore, we want to suggest that we need to start with the end of fiscal policy. What's the purpose? What is it trying to achieve? And we would say that it needs to be related to social welfare criterion, and it needs to generate both robust and inclusive growth. And that also means both ecologically more sustainable and socially more balanced. So that's for fiscal policy, and it's very important that we bear that in mind as we emerge from the shadow of COVID-19. And monetary policy can support fiscal policy efforts, indeed has to support them, but we cannot run the risk of undermining long-run price and indeed financial stability or the operational independence of central banks. So we've also published some work earlier this week on how to begin an exit from quantitative easing and from all the questions related to the bank's operation. And we do think that this is a major issue now for policymakers. There are other questions. So as you know, the vaccine cloud is being lifted, we can see that the rebound is very much the lockdown contraction in reverse, thanks to the rollout of the various vaccines. But it's also clear that despite strong growth in Q2 and for much of the rest of this year, we are also very keenly aware that 2 years of output have been lost. And so world economic output is some 3% lower, or will be some 3% lower in 2025 compared with pre-pandemic trends. So there's scarring, which is permanent and won't just be easily recovered. Over 4 million deaths around the world, much higher public and private debt levels. Again, path dependency would suggest that they won't just revert to previous trends. We have escalating asset prices, in part as a result of QE, but also macro stabilization options are limited if and possibly when the next crisis hits. There's lots of heterogeneity in outcomes, whether it's within more advanced economies, including within the Eurozone, but also outside in the US and the UK, but all emerging markets, of course, and elsewhere. Some huge question marks over the state of global corporations, whether it's vaccines or climate change or special drawing rights or even fiscal policy. So the era of multilateralism that we may have seen in the 90s seems to be well and truly past. And the question is, can we revive it? Who will do it? And what might it look like over the coming years? And then for the UK economic outlook, as we emerge from the shadow of COVID-19, yes, the recovery is very much underway, but it won't be complete until early next year. That is our projection. Yes, there are very encouraging signs in terms of vaccine take-up, certainly among all of the age groups that it's been offered to, and there's still some way to go for some of the younger people. And also some encouraging signs on possible moves towards herd immunity, where most people are very unlikely to catch virus. However, caution also demands that we are prudent as we lift restrictions and that we don't see other spikes, whether it's possibly to do with the Euros or indeed the opening on the 19th of July in England, which will be followed, of course, by opening in Scotland and elsewhere. Crucially, not all sectors and regions will recover by next year. In fact, just the opposite, as my colleague Anna will outline later on. And that means we have to pay very close attention to both regional and industrial policy in order to really help with regional regeneration, much better than we have done in the last 40, 50 years. So the onus on policymakers really could not be more important. The large output fall in 2020 also exposed other structural problems in the UK economy, whether it's some of the questions around regional balance, but also manufacturing industry, the reliance on overseas production, and possibly on foreign powers that we may not be able to trust. And just briefly on scarring, we've seen higher public debt levels, now over 100% of GDP, unemployment that could well peak at 6%, but also other labour market issues that will be touched upon by my colleagues, especially the transition from job to job or from education to employment. The QE programme I've already touched upon, some shocking projections in terms of rising levels of poverty in the institution unless targeted policy reduces those, and then also some firm dynamics. Very strong firm births in London and South East, but just not enough elsewhere, which has huge repercussions on employment. And in fact, we're seeing more unemployment and also greater inactivity, which is extremely worrying as workers are so discouraged that they drop out of the labour market altogether. So there are some very encouraging signs, but also some darker clouds on the horizon, and we need to be very aware of those as we move along this recovery path. Now, I'd like to introduce the first presentation, and my colleague Barry Naisbitt, who's Associate Research Director for Global Macroeconomics, and he's going to talk to us about our global economic outlook for the summer of 2021. Barry, thank you very much. The floor is yours.
Thank you very much, Adrian, and good morning, everybody, and thank you for attending today. I just want to run through really rather quickly our global economic outlook that we've published just earlier this week. As ever, we're using our own macroeconometric model, our global macroeconometric model, NIGEM, to run the forecast. And it's very much a team effort in doing it. And I'd like to pay tribute to the efforts of my colleagues who are named on the slide here for all their hard work in doing that. In particular, Corrado Macchiarelli and Jan Eliadze for all their hard work in getting the text through the final gate. So what are we saying in our economic outlook? Well, I think we've probably got three main points, and then I will elaborate on those. The first one is that we've seen stronger than anticipated GDP growth globally in the first quarter, and the second quarter also looks reasonably robust. And as a result of that, we revised up our projection for global GDP growth this year from 5.5% to almost 6%. Alongside this, though, we're now seeing signs that inflation is increasing, particularly notably in the US. And although we expect inflation to keep increasing for a little while, certainly in some countries, we expect, or we're projecting, that increase in annual inflation to be a temporary one, with inflation globally on our OECD measure falling back towards 2% as we go through next year. Of course, in forecasts, we have to fill tables with lots of numbers that are accurate to one decimal point, which I think gives a slightly misleading picture of where the world economy currently stands. The virus is still very much with us, and it means that the economic outlook remains uncertain, particularly for emerging economies, particularly for those economies where vaccinations have not proceeded as quickly as in other economies. So, in terms of our GDP growth projection, it's clearly encouraging, but we don't really feel it's what we'd call big news. The big news, I think, is still about the divergent experience across economies, both in economic and in health terms. And the uneven distribution of vaccines remains a very important factor in this. And I'll show some charts in a minute to explain what I mean by these things. The major new issue, I guess, for us is the increase in inflation. While we think it will be temporary, we don't know for sure. And we certainly don't know whether the Federal Reserve will keep thinking it's temporary or will need to move early to tighten policy. When we look at what's happened in the first and second quarters of this year, two pictures quickly looking at quarterly changes in GDP. The left-hand side shows major economies, China, Euro area, Japan, US. The right-hand side is looking at emerging market economies. You can see that the major economies almost all are expected to have growth in the second quarter of this year. The PMI figures are obviously encouraging on that, although both the Euro area and Japan did not have that strong first quarter of the year. But looking at countries that have had weaker second quarters, clearly Brazil and India stand out. And there we've seen that's probably related to the progress of the pandemic. But the key point is that comparing the experience this year in quarters 1 and quarter 2 with comparing last year, quarter 1 and quarter 2, you can see that the output hit is very much smaller in every country there. So that's the positive side of that. In terms of divergent experience, two ways of thinking about this. First of all, this chart simply plots the percentage change in GDP by country between the end of 2019 and the middle of this year. And you can see that we're projecting Chinese economy to grow by about 8% to 9% over that period, but the Spanish economy to show a fall of around 6 to 7%. A wide range there across countries, and quite evidently the European countries there, the major European countries there, have not done very well relative to some other economies. But you'll notice that the world economy is actually slightly positive at Q2. So globally, the world economy has recovered where it was. But when we look forward between the second quarter of this year and the end of next year, equivalent period in time, what we see is two things. One, we're expecting almost all those countries that we're talking about to show economic growth, and the extent of divergence between them is much smaller. So Japan around 4%, India around 10%, a much narrower range of experience, but still quite wide, reflecting both recovery from the pandemic, but also underlying economic conditions. In terms of contributory factors to that, clearly the vaccination process is helping economies recover. And looking at this chart showing the progress of vaccinations in each quarter, you can see that there's been a great expansion in the second quarter of the year relative to the first, and also in the first quarter relative to where we were at the start of the year. That offers some hope for normalization of economic activity, but the pace is clearly very uneven. Countries like UK, Canada, US leading the pack, but countries like South Africa, India, Indonesia, towards the back of the pack. And there are many countries, as we document in the report, where the vaccination rates are very, very low. If we move on to looking at what that means for mobility and the recovery of economic activity, we can see that looking at these Google mobility indicators in the major advanced economies, they're pretty much back to where they were before the pandemic started. So not quite normality, and clearly some differences across countries, but a more encouraging picture than we would have seen 6 months ago. In terms of global GDP growth, our projections are for growth in both this year and next year. We have 8 economies on these charts. In all those 8 economies, one point that I draw attention to is we're expecting slower growth next year, about 4.5% globally, compared to around 6% this year globally. So this year is a part of a rebound effect, and next year that rebound effect is starting to wear off. While I'm talking about recovery, and I'm talking about recovery to where we were before the crisis started, so end of 2019, you can see from this chart that although the US and China have now recovered to where they were, this is not true elsewhere. We're expecting the euro area to take until the middle of next year to get back to its 2019 level of GDP. So economies are recovering, but not all have recovered. And as Adrian mentioned, there's a scarring effect on GDP, where we think that by 2025, global GDP will be about 2.6% lower than we expected it would be before the pandemic struck. And the cumulative loss relative to our expectation is around $29 trillion. So a sizable loss of activity. At the moment, we're not looking as if we're showing GDP growth rates going forward into the medium term being notably different from what we were expecting before the pandemic, but we do know there have been hits to human capital formation, for example. In terms of the Outlook report itself, if you read it, we have a very neat NIGEM topical feature by my colleagues Corrado and Diana, looking at the EU Recovery and Resilience Facility. And we've used our NIGEM model to simulate that, rather like we did on the US American Recovery Plan. And what we're looking at, a plan of around 800 billion euros over a period of around 5 years. So it's a medium-term plan, as opposed to the American Recovery Rescue Plan, which was very much a 1 to 2 year plan. And it's a complex mixture of grants, loans, and productivity effects. And the topical feature goes into a lot more detail. I do recommend people have a read of that, because I think it's a really interesting thing that's coming up on the horizon for the European economy. We expect it to be positive for GDP growth, about 0.8% on GDP on average over the 5 years, between 2.5 and 6. But a lot of that will depend on the take-up of the loans. And if there's maximum take-up of the loans, the effect could be even larger, as you show there, around 1.5%. Moving on from that, talking about inflation, the left-hand chart shows core inflation in the US, Euro area, and Japan. There's clearly a strong rise in US core inflation and in US CPI inflation, back to CPI inflation back to levels last seen in 2008, 2009. And that's coming from a range of factors, including the base effects, commodity price increases, supply chain bottlenecks, and some particular factors like used car prices in the States. We're expecting some of these effects, certainly the base effects will drop out as we go forward. And as you can see on the right-hand chart, we're projecting that the inflation rates will start to come down again as we move through 2023. In terms of financial markets, the increases in the US 10-year yields that we saw back 6 months ago have started to come off. Perhaps that's surprising given the rise in inflation that we've seen, but very much the market narrative is about two things. One is about fears of growth slowing in the US from the current very rapid pace of around almost 7% this year, but also something perhaps to do with the rate of issuance or the rate of buying of new QE in the States. Of course, the other big issue is that government debt has increased, and we've seen government debt rise by 15 to 20 percentage points in the advanced economies, around £7 trillion. We're expecting that to stabilise going forward, but perhaps rather less well known is the increase in private debt in all these economies, which we show on the next chart, which looks at the private non-financial sector debt as a share of GDP in advanced and emerging economies. You can see that emerging economies have grown quite rapidly over the last decade, but particularly rapidly over the last couple of years. And after a period of more or less stability over the past decade, you've seen growth in private non-sector debt in advanced economies as well. So exposure to rising interest rates is both a public sector and a private sector issue. Of course, there are risks to our outlook. We talk about those in more detail in the text itself. Further waves of the virus, the need for vaccinations of emerging market economies. These are not new themes, of course, but they are important because they are still with us. There is the possibility of the inflation risk from running the US economy hot, both in the US and then translating to other economies with possibly adverse effects on other, particularly emerging economies, particularly if interest rates start to rise. And as Adrian mentioned earlier, I mean, there is a risk to another negative shock, particularly because monetary and fiscal policy space has been used in great extent in the last year and a half. And another negative could really test the resolve of governments and central banks. Let me just summarize very quickly. Economies, by and large, are getting nearer to recovering the GDP levels they had before the pandemic struck. But the race is still on for very many countries to get back to where they were, to recover. We think that the recovery by itself is still fragile to further virus waves, but we're increasing our global growth forecast from 5.5% to around 6% this year and 4.5% next. That reflects the resilience that we've seen against the continued virus, the vaccine rollouts, and particularly the US fiscal stimulus feeding through. Clearly, all eyes are still on this idea of mass vaccination globally, not just mass vaccination in one country. And finally, the new thing to watch is obviously inflation. Will that rise in inflation be temporary, or will it be a little bit more longer lasting? We think temporary, but obviously the jury's still out on that one. There's a long way to go. Let me leave you just with our headline numbers, and which you can find much more detail on text. And I'd like to introduce next my colleague Dawn Holland, who's done some really interesting work on in the UK chapter of our outlooks on the UK foreign aid position. So thank you all for your attention, and over to Dawn.
Thank you very much, Barry. And also I want to say thank you to my co-author, Dirk Willem de Velde from the Overseas Development Institute, who initiated this note that looks at recent cuts to the UK's development aid budget. So let's look at what exactly has happened to UK overseas aid. Last month, Parliament voted to maintain the cuts to overseas development aid that were announced in the spending review for 2020. And this reduces the amount of aid this year relative to what had been previously planned by roughly £4.5 billion. So to put that into context, it represents a relatively small share of total government spending, less than 0.5%, but represents nearly a third of UK's total overseas development budget. So it will necessarily entail some significant cuts in many development programs. The cuts also mean that the UK will fall short of meeting the commitments that were set out in the 2015 International Development Act, when it pledged to maintain an overseas aid budget of at least 0.7% of gross national income. So let's start with a bit of background on the 0.7% target. Where did that come from? Well, it's not a new target. This is a target that was originally set out in a UN resolution that was adopted in 1970 for all economically advanced economies to provide at least 0.7% of their gross national income in development aid. So back then in 1970, the plan was to achieve that target within 5 to 10 years. So shift forward 50 years on. Last year in 2020, the UK was one of just 6 OECD countries that achieved this target. So without the UK, that drops down to just 5 countries. So quite a big shortfall in the planned development budget. What are the arguments in favor of cutting aid? So the COVID crisis, as Barry was just saying, has certainly put a strain on public finances. Government is quite naturally seeking ways to help stabilize the fiscal position. So the ODA cuts have been justified on the grounds of fiscal prudence. But this, in fact, may actually be counterproductive given the positive economic spillovers from overseas aid. Who is going to bear the costs of the ODA cuts? Well, the bulk of the cuts will fall on UK bilateral aid. And these flows are a crucial source of finance in countries with limited access to international capital markets and where extreme poverty rates tend to be very high. For example, a 30% cut in UK aid to fragile countries, including South Sudan or Somalia, would leave a hole in the country's financial resources in excess of 1% of their GDP. Some examples of the more specific consequences that these program cuts are likely to have show that the costs will fall on healthcare, education, provision of basic services, protection of the environment, etc. But in addition to the humanitarian and social costs, the decline in development aid will have important macroeconomic consequences as well. The academic literature, as surveyed by Arndt, Jones, and Tarp, shows that development aid raises economic growth in recipient countries. Furthermore, joint studies by NISR and ODI have shown that aid flows often have positive macroeconomic spillover effects on the rest of the world, and that includes in those countries that are providing the aid. So in other words, that means that aid often, at least partially, pays for itself. The ODI studies have also looked more specifically at UK external aid, and they estimated that UK bilateral aid provided 12,000 UK-based jobs in 2014. And the UK may also receive indirect benefits from the provision of the global public goods. So the cuts in the UK budget are intended to be temporary. The government plans to return to spending 0.7% of GNI on aid once a set of fiscal tests have been met. Now, these tests are conditional on both attaining a current budget surplus and a decline in the aggregate debt stock. Now, in practice, these conditions have been met only 5 times in the, since 1990. And according to NISR's current forecasts, are unlikely to be met before the fiscal year 2025-26. So that means that the cumulative aid losses may rise to somewhere around £25 billion. In addition, this sort of policy bears all of the hallmarks of the sort of arbitrary fiscal rule that Adrian was referring to earlier on, by conditioning a specific category of spending, which is uncharacteristic of standard UK fiscal policy, which generally tends to avoid hypothecation and earmarking. It also ignores the fact that aid flows should often be treated as investment rather than current spending, with potentially high returns that may actually reduce the debt ratio. So in conclusion, the recently announced cuts in UK aid will provide negligible direct savings to the UK government. They will pose significant humanitarian and social costs in many poor countries, and they also ignore the potential positive macroeconomic spillover effects in terms of UK jobs, costs, and trade, and so may in fact delay rather than accelerate the stabilization of public finances. So thank you very much for your attention. I will pass on now to Cyril for discussion on the UK outlook in more depth.
Thank you very much, Dawn. It's fascinating to see how NISA can be an independent voice in the policy debate. So I will present you the common work with Hande Kutchuk and Rory McQueen on the UK economic outlook that we titled Shadow of COVID-19, Emerging from the Shadow of COVID-19. So the headline is that there is an improved outlook compared to our May forecast. So GDP has been revised up to 6.8% from 5.7% in May. So there's been some positive news and the development related to vaccination and soft indicators are better. And but that doesn't mean that that we are out of the woods, and some risks are clearly building up. We estimate that the Brexit and COVID-19 will leave the UK economy 3% below the post-GFC trend in the medium term. There is a lot of uncertainty around unemployment and the end of the furlough scheme at the end of this year, but we estimate that it will rise moderately to 5.4%, which is consistent with around 150,000 people going from furlough to joblessness. So we expect CPI inflation to reach as much as 3.9% at the beginning of next year. That means the MPC should prepare the ground for normalizing its monetary policy stance, and hopefully we'll learn about it today with the MPC announcement. On the fiscal side, so we argue for greater parliamentary scrutiny related to the next spending round in October. So on the GDP side, if we can move, yeah. If I carry on the metaphor from Barry about the race, then the UK would win the gold medal for GDP growth in this year, after among the G7 countries, just slightly above the United States. But of course, after being the worst performer in 2020. So there was several factors explaining this rebound. So you have the vaccination program that went well. You have the bounce back from last year and with the reopening of the economy, and also fiscal support. So if we look at the more short term, so we will learn next week about the GDP for the first quarter. But in our forecast, we have a strong rebound of close to 5% in Q2, and then growth slowing to 2.6% in Q3, and then even lower in Q1. So it is driven by a rebound in private sector investment, and to some extent in household consumption. But there were risks on either side, with the fact that the reopening of the economy and the rebound may sort of peter out, and there were still some supply chain issues, and also on the labor market there were reports of shortages in some sectors. So the beginning of the year was, of course, the time when the new Brexit trade agreement was implemented, and so what we've seen is a very large drop in imports and exports from the EU, and also, of course, related to the lockdown. But what's quite interesting is that EU imports have not recovered very much, so there's still some scouring here, and so it's mainly goods, but also in some specific sectors like financial services, EU imports are very low, which to some extent helps the trade balance. And so our vision for GDP growth this year is based on higher investment and a better trade balance. So in terms of the risk around this forecast, so the downside risk of further waves from COVID seems to have receded, and so that's why the outlook is a bit better. But there's still some significant cumulative loss in GDP, of course, that have been lost last year and this year compared to the pre-pandemic trend. In terms of upside risks, so I can say the faster reduction in forced savings, and also a stronger rebound in business investment that could be spurred by the super deduction. But on the downside risk, there's still quite a lot of uncertainty around the pandemic, and rising inflation is clearly one of the top risks for the UK economy at the moment. So when we use our new sort of sectoral model, NICEM, we can now do some sectoral forecasts, and we compare here the gross value added growth in this year compared to last year, and what you can see is that, I mean, there's no sector that really sort of rebounds quicker than it dropped last year. But some sectors are doing better than the average. So construction is seeing a strong growth this year, and the public sector is also pushing up growth this year. And private non-traded services, which includes things like retail and other services, we also sees an important growth this year because of the reopening of the economy. So if I move to the labor market, there's been some sort of worrying signs about some possible mismatch between where there's labor demand and where's the labor supply. So what we did in this outlook is compare the vacancies in each sector with the number of furlough in each sector, and while you can see that they're broadly quite well correlated, some sectors really stand out. So in health and social work, there is some labor shortages with much more vacancies than furloughs. Whereas on the in accommodation and food, there's 5 to 6 times more furlough than vacancies. So that suggests that there is excess labor. And of course, the pandemic also adds to this labor shortages issue. And really the key question is how will sort of the labor market be able to sort of reallocate its resources between the sectors that need them and the sectors that are still scarred from the pandemic. So moving on to unemployment. So we've sort of significantly downgraded our unemployment forecast. So it's now 5.5. It's now peaks at 5.4%. Sorry, so there will still be some a surge in unemployment because of the end of the furlough scheme, but we now think that it will be quite moderate, and so that's why we've revised down our forecast. But what's interesting is that the unemployment rate doesn't tell the whole picture about the labor market, because if you see on the right-hand side, this chart shows you that the decline in the sort of people in activity is mainly driven by not driven by a rise in unemployment, but is explained by the fact that you have fewer people active in the labor force. So that can be either people who went from to left the labor force for looking after their children, or they could be also people who left the country altogether. And I'm thinking about some EU workers here. In terms of the fiscal side, so stronger GDP growth reduces the debt burden, all things equal, and so we did a small sort of back on the envelope calculation that public investment could be increased by 30 billion if we were to keep a stable debt to GDP ratio until the end of the forecast period. So turning to inflation, and which is sort of the biggest risk for the UK economy. So annual inflation reached 2.5% in the latest data, and that's up from 0.7% in March. And this was driven mainly by sectors like transport, and also the reopening sectors like restaurants and hotel, recreation and arts. And also it's worth noting that there's been a very high rise in input producer prices, which has fed into a higher consumer goods prices. But we don't yet see any sort of sustained pass-through to services prices, but this may happen later in the future. And in terms of how markets have responded to the rise in inflation, so far inflation seems to be on check, and there's no sort of sustained rise in inflation expectations. What this means is that we expect inflation to rise to 3.5% at the end of the year, and peaking at 3.9% the first quarter of next year. And so that's driven by some base effect and some VAT rises. There's a box by my colleague Hugh Dixon that explains how these temporary factors feed into the headline inflation. But after that, we expect inflation to settle around the 2% target starting in 2023. And this forecast is, of course, conditional on interest rate rising in the first quarter of next year. I sort of mentioned the interest rate, but what will happen to QE? So there's another box in the outlook about the long and uncertain road to exiting QE. and that sort of essentially looks at what the literature tells us about the channels of QE and what it means in terms of how QE can be unwound. So what we find out is that we know precious little about the effect of unwinding QE, just because it hasn't been done so far. So we know that the channels of QE are signaling portfolio rebalancing and liquidity premium, which you can find more in the box. And we also know that because of the taper tantrum episode of 2013 in the US, that exiting QE should be done in a gradual and predictable way. And hopefully we'll learn from the Bank of England data today about how they intend to do that. And the literature estimates also tell us that a rise in 10% of GDP of yield purchases by the bank increases yields by 150 basis points. So a simple calculation tells you that if the bank were to sell all of its assets, then yields could increase by as much as 2.2 percentage points. So the next question on exiting QE is what's driving, why do you want to exit QE? So is it about normalization? So going back to an environment where you have mainly bank rate and higher interest rates, or is it about monetary tightening? And of course, it can be a bit of both. And in terms of interaction with the bank rate, so the main question is, what is the marginal instrument? So QE is more uncertain and possibly more sensitive to market conditions. So really there were some arguments both ways to either increase the bank rate or unwind QE first. There is also an interesting sort of policy paper that was published last week by my colleagues Allen, Chad, and Turner, that you should read about the Bank of England independence from the Treasury and what's the impact on QE. So to conclude, despite a more positive short-term outlook, uncertainty remain quite at elevated levels. So we don't quite know the COVID endgame. There were some large labor market adjustments that may come very soon, and inflationary risk are spreading. So Brexit and COVID-19 leave the UK economy 3% smaller, and it's time for a new fiscal framework. And also the Bank of England should prepare the ground for monetary policy normalization. So thank you very much for listening, and I will hand over to Professor Anna Bhattacharjee to talk about the regional aspects.
Thank you, Cyril, and good morning, everyone. As might be expected, the continued impacts of the COVID-19 shock, compounded by Brexit uncertainties, have been falling unevenly upon the UK population. This is by region, gender, age, household demographics, and race. Using the National Institute's new regional modeling system, NIREMS, under continued development, we bring to you today a flavor of these differential impacts through projections moving forward. This is very much a joint work with a lot of colleagues, a team of researchers at NISER and Associates. Some key highlights emerge from this analysis. First, as the UK economic growth accelerates, the recovery in the devolved regions and the devolved nations and regions will vary significantly in terms of gross value added. Unsurprisingly, these regional variations fall very much along expected lines of large regional inequalities in the UK that have persisted over a long period of time. For example, the region that is lagging most behind will be the Northeast, which will be below 3% below its pre-pandemic level. Second, as pointed out earlier, there is permanent scoring, particularly in regions and demographies with persistent vulnerabilities. In fact, no region or devolved nation shows signs of returning to pre-pandemic trend as far as we can see. Loss in GVA relative to pre-pandemic levels of trends varies widely across regions, with the Northeast again 9% behind pre-pandemic, pre-COVID trend. Third, and very concerned, a matter of much concern, after the withdrawal of furlough scheme, labor market issues will be very key. We project sharp rise in youth unemployment, with more than 100% of young men unemployed, additional young men unemployed, and 70%, more than 70% increase for young women, but also very sharp increase in inactivity levels, particularly in Wales and Northern Ireland. This reflects people moving out of furlough straight into inactive economic status. So this is a matter of grave concern and requires urgent policy redress. Fourth, income, consumption, and savings rates across the UK, they exhibit both commonalities and differences. The savings ratio is rising everywhere amongst all kinds of households, across the income distribution, across different household compositions, and so on, and races. So for the top quartile income households, savings ratio has increased from about 30% in 2019-20 to about 40% in 21-22. And for the top decile, this has risen from about 40% to above 50%. Finally, household dependency on benefit income varies significantly across income categories, households with or without children, and ethnic composition. In aggregate, the dependency is about 20%, but then for households in the lowest income quartile, it is 85 to 90%. And out of that 85 to 90%, 16% is contributed by enhanced universal credit uplift. So that is very significant. It is actually 22% for the lowest decile. 60 to 65% benefits share for single parents with 2 or more children, and 30 to 35% for Black and Asian other than Indian. In terms of GVA, most regions in the UK will return to about 2019 Q4 levels, that is just before the pandemic levels, by the end of 2024 Q4. However, it is still way away from pre-existing, pre-COVID trends. In fact, we reckon by as much as 5 years for the North and for Wales and Northern Ireland. Employment recovery on the next slide also shows similar variation across the nations, most robust in Wales and Scotland somewhat lagging behind. But the trend for England, which is in the middle, masks wide dispersion across the English regions, with London pushing ahead at great pace and other regions, particularly the Midlands, lagging far behind. This two-paced progress, so this is England in the middle, you can see England in the middle, Wales at the top and Scotland below, and on the next slide you can see the regions of the English regions. So that is quite stark. You can obviously see London moving ahead at great pace, and other regions of England falling far behind, particularly the Midlands. This two-paced progress is also seen in labor productivity in output per hour, whereas before, London is the clear winner. The devolved region, nations of Wales and Northern Ireland lag behind aggregate levels and trends, as to the North and Midlands. But employment in London itself reflects a mixed bag, with the highest and rising unemployment rates on the next slide, but that is against comparatively much larger and stable population in the labor force. So the inactivity rate is much lower. Consistent with aggregate projections from NIGEM, unemployment rises across all nations and regions of the UK. Trends in unemployment rates are also consistent with withdrawal of the furlough scheme. However, the more disconcerting feature is this high and rising inactivity. Across most regions, except London, this reflects large and disaffected workforce with skills jobs retraining policies, skills jobs retraining policies must urgently address. Youth unemployment is a particularly critical feature, reflected in doubling of unemployed young men and a rise of 70% amongst young women. Transition into inactivity is particularly strong among women across all age groups, as well as young men. Finally, a new feature in the current outlook is decomposition of household income into its sources, mainly wages and pensions and benefits, and usage, consumption and savings. As expected, there is substantial variation in the share of benefits in total income across regions, but the patterns fall along persistent and well-entrenched regional fault lines. Here, Northern Ireland features quite prominently with a rising trend, which is particularly alarming, but so is Scotland. But perhaps the most significant story is the persistent rise in savings across all regions, income groups, and demographic cohorts. This challenges the notion of consumption-led recovery that many have been hoping for. Together with inactivity rates, this is an important concern for policy. There are a lot more details in the outlook itself, but let me leave you with a few policy prescriptions that we see coming out of these numbers. In the short term, we think that income sustenance by extending the universal credit uplift to help the poorest households will be useful. This uplift accounts for less than 5% of the total benefits budget, but its positive impacts fall disproportionately upon the very poor households, and it is a lifeline for them. So not only for their welfare, but also for raising consumption, this may be important. In the medium run, we think that we suggest that retraining and good green jobs are very essential, particularly with alarming trends in inactivity rates. A key task then for policymakers is to channel higher savings towards investment to promote regional regeneration, including regional and sectoral sources of income for businesses. Consumption, we think, can be promoted together with a zero carbon agenda, which is very high on the government's prerogatives, by providing incentives for adoption of green technologies, for example, electric and hybrid cars, as well as energy efficient housing. We have some highlights repeated again on the next slide, but here I want to hand it over to Adrian again. Thank you.
Well, thank you so much, Barry, Dawn, Cyril, for these very rich presentations. We are a little bit behind schedule, so I propose we take 10 minutes or so, because there have been some terrific questions in the chat, and we definitely want to make time for those. Can I start with a question from Sheila Page, who's asking, does the scarring effect slide suggest that the scarring will be less to levels and rates than the scarring from the financial crisis? Now, this is a question I think that relates to the global economy. So can I ask Barry to come in on that question from Sheila, please? Barry, have you got some thoughts on Sheila's question?
Yeah, sure, Adrian. Couple of quick thoughts, Sheila. First of all, I think in terms of scarring, the main effect that I would pick out from the global financial crisis was or has been the much slower rate of GDP growth globally, and certainly amongst advanced countries post-GFC than pre-GFC. Now, we don't currently expect to see that same effect happening this time round. when I was trying to think about the answer to the question, I was wondering though whether maybe if I were to go back to the pre-GFC days, maybe all we economists thought that the world of relatively strong advanced economy growth was something that would just keep going. I'm not sure about that. That's one interesting one to look at. But we're not expecting the scarring in terms of growth rates to be anywhere near as severe, if I put it that way, as it was in GFC.
Barry, since I have you already, may I put another question to you, which has come from Alan Bridle at the Bank of Ireland, and that is, to what extent are international comparisons of GDP problematic at present, given data issues and different methods of calculation? For example, the UK approach to public sector activities. May I ask you for some views on Alan's question, Barry?
Yeah, it's a great question, Alan, and I think one of the difficulties is around this difference in particularly the public sector. If you look at the education and the health figures, output figures for the UK, they show much bigger drops than elsewhere. That said, it doesn't change the bigger picture of there having been a huge drop in output in the UK, and also huge drops in output of countries who calculated the output of public services differently. I think generally, as an issue, this sort of slightly different way of calculating GDP is still an issue for economies over the place. I also think it's an issue more broadly, and something that we at the Institute have looked at quite a lot about, is GDP really the thing we should be measuring in some ways? How, if we're talking about wellness and well-being and all those sort of things, how are we really measuring those? Does GDP measure up to that? But I also noticed, Alan, you're from Ireland, which is one of the countries when I look at it, I have probably the most trouble reconciling the GDP figures for. And probably GDPI in Ireland is more representative of what's going on in the economy there. So I think it is a broader issue, and perhaps some of the things about taxation and multinationals going forward will help even out some of those things.
Barry, thank you very much. And last but not least, a question from Yin Jin to you, which is, what are the main reasons for private debt, for the private debt increase?
Well, thanks, Adrian, and thanks, Ying. One of the key things that's gone on in the past couple of years, at least, to explain sort of the private sector debt GDP increases, has been the hit to cash flows that businesses have seen with the sharp contraction of demand as social distancing measures and lockdown restrictions have come about in many countries. And one of the things that has resulted from that, of course, is that many governments have put in place loan schemes to companies to help them bridge that period between demand falling and demand starting to come back. And so a lot of countries, a lot of firms in a lot of countries have increased their borrowing from governments or agencies set up by governments to help them. So that's part of it. I think there are two other issues. One is that if you look back over a longer period, real interest rates have fallen fairly steadily over the past 10, 15 years. And I think that plays a part in the increase in debt more generally. And it plays a part particularly for emerging market economies, where not only have real interest rates fallen over time as on a global scale, but also companies become more able to access international capital markets over the past 10 years or so, and have taken the opportunity to raise finances that way. Certainly the growth of dollar debt in dollar-denominated debt in companies in emerging markets is a theme that some of the international agencies talk about quite a bit. I hope that helps give a flavour, at least, of some of the main things behind it.
Many things indeed, Barry. There's a question from Enfield on trade, which I'm going to ask Cyril to respond. This question in two parts. Do you already see structural change of the UK and global supply chains post-Brexit? And how strongly will the gradual phasing in of UK customs bureaucracy affect UK imports from the EU and UK GDP growth from October of this year and January of next year? Cyril, may I turn to you, please?
Yes, thank you very much for the question. So, I mean, it's a bit difficult at the moment because we have those two effects of COVID and Brexit to disentangle. But we start to have some data on the impact of Brexit on trade. And I mean, the clearest one, so we've seen was like EU imports being, having not recovered while imports from the other countries have. So that, as the question says, as there'll be more checks on EU imports, then it might even prevent a further recovery in EU imports. And one sector that we have some evidence on is financial services, where sort of the deal was sort of already in effect much earlier than in other sectors, and this is where you can see that financial services imports have increased from the US and Asian countries, and have declined from the EU. So it's one sector where there has been some reallocations towards the rest of the world. But yeah, we're waiting for more data in other sectors to dive into that.
Thank you, Cyril, very much indeed. We have another question from David Marsh, and this is about wage inflation. So wage inflation, signs yet of de-anchoring, but early days yet. What would you expect to see this in, and what would be the triggers, size of deals, importance of deals, etc., that could spark action by the Bank of England? Have you got some of that, Cyril? We can ask Barry for his views if he wishes to come in this one.
Okay, I mean, I can have a quick start. So, sorry. We have our underlying wage tracker, which says that wage growth was 3.5% in the last reading, up from 2.5%. So there is some evidence of wage increasing, and in particular for like new starters. You can see it, but at the moment it's very much in some sectors and not in every sectors, and it's driven by some temporary factors in terms of labor mismatch and some supply chain issues. So in terms of the Bank of England, it only matters if it's widespread wage inflation across all sectors. So rather than following one sector in particular, I think I would look at the extent to which there's spillovers to the wider economy for the Bank of England to estimate that it's not a temporary rise, but it's more permanent.
Thank you, Cyril. Barry, any additional reflections on that question by David?
I was going to say, not really. I very much agree with Cyril's point that, I mean, for the Bank of England, it's going to be the economy-wide issue that pertains. I mean, at the moment, we do hear of sectors reporting labour shortages, and obviously, traditionally, economists' supply and demand diagrams might say, well, if they paid higher wages, they would have fewer shortages. But I think that, those are probably going to be reasonably temporary factors reflecting specific issues to those sectors. There aren't widespread labour shortages being reported, but at the moment, clearly the unemployment rate is higher than it was pre-pandemic. So there is a possibility that the labour shortages can start to be filled by some of those people who currently haven't got jobs, either are unemployed or are not participating in the labour market, or perhaps with some retraining, people then can take up those positions. So I very much agree with Cyril about it's the overall picture that's going to matter, I think, for the Bank of England.
Thank you, Barry and Cyril. That was very helpful. We have another question from Stephen Clark, which I'm going to ask Handa to respond, if I may. And that is, of the 3% below the post-global financial crisis trend that you expect the UK economy to be due to Brexit and COVID, how much of this is COVID? Can we disentangle the COVID effect already? Handa, may I?
I mean, it's a very important question. We also think about it a lot. There are a lot of factors at play there. It's not only Brexit and COVID, but all the current forecasts, involve information about how we change assumptions regarding fiscal policy as well. But looking at different indicators, we think that the 2% of this effect is due to COVID broadly, but it's difficult to identify precisely the COVID effect, but our estimation is that it's around 2%. We have revised it down compared to previous forecasts, as our forecast for GDP this year and next year were revised, because this is a scarring estimate based on the forecast, the latest forecast on the level of GDP compared to either post-GFC trend or compared to a pre-COVID forecast. So the revisions to our GDP forecasts in the coming 2-3 years affect these scarring estimates. So they have been consistently revised down.
Thank you very much, Handa. And a final question from Mark Lenfield to Arnab. Mark says, it seems clear levelling policy may not be visible for the British region future, despite the many billions of pounds that are invested by the government, at least announced as future investment. How does that come about? Why will given drug growth rejecting it? Answer you for that question.
Thank you, Mark. But this is a very important question, and it's really $1 million question. You look at the regional profiles, they fall along expected lines, and these have been persistent over a long period of time. Of course, people recognize this. There's the question of the levelling up agenda. There's the question of the UK 2070s Commission, which has been bearing upon these issues. And everybody recognizes that the solution, because the problem is persistent, the solutions are also very long run. They are not going to happen overnight. Now, NIDEMS is beginning to give us a framework through which we can start asking the right questions and start finding some sort of right answers in line with the levelling up agenda. For example, when we see rises in inactivity rates, particularly in certain regions, we can then anticipate that maybe somewhat low-hanging fruit there might be going into the skills jobs, nexus in those places, and try and do a little bit with retraining to try and bring about some sort of leveling up specific to those regions. Similarly, when savings rates are higher, we are asking the question as to whether this could be channeled into business investment, specifically in the regions which are lagging behind, to try and bring about some momentum towards leveling up. Now, we are far away from answering those questions as such, and they are very long-run questions in general, but I think there is more momentum in the right kind of place to think about these issues in the medium to long run, and in terms of providing policy tools to address those questions, and NIDEMS is trying to build that up. I think that is kind of perhaps not a very satisfactory answer to your question, but probably you don't expect that much as well, because we do not have the mechanisms to clearly go into finding well-calibrated policy solutions at this point. We are getting there. Thank you.
Yeah, thank you, Anna, very much. And indeed, that is part of the work we are going to be developing and taking forward at the National Institute. May I thank my colleagues, Barry, Dawn, Cyril, and Alp again for the very rich presentations and for their responses to the questions. May I thank you above all for joining us this afternoon, for your interest in our work, for your brilliant questions. Please keep them coming. Be in touch by email or social media. We'll be very happy to answer more questions. Thanks again for all your support, and we look forward to seeing you at a future event, indeed at our next economic forum in the autumn, but we'll have lots of publications and events before then. Please be in touch, and we certainly look forward to seeing you again very soon. Thank you again very much for being with us this morning, for making the time, and I wish you a very good afternoon. Thank you, and bye-bye.